right, guys, can you all hear me? Okay, good. Now, okay, welcome back. Now, before we continue, I just want to show you a few things. Now, if you log into your Blackboard, you should be able to see this. Okay. Now, all your lecture notes, the PowerPoint slides, is all available here. For example, today is topic number 1. Okay. So if you click here, you will be able to see the lesson material here. Okay. You can either view it online or you can download it and print it out. Okay, it's up to you. Now, so this is where the material is. So this is for topic 1, and then next topic 2 is from here, and so on. But I want you to scroll all the way down. Okay, scroll all the way down, and you can see there's a folder here called revision. Can you see it? Okay. One more time, let me show you. Okay, if you scroll all the way down, you can see there's this folder called revision. Now I want you to click this, and over here you will be able to find all the sample paper. These are collections of past year exam paper. Okay? Now these are for your practice. But there's one particular set, the last one, the tutorial questions. Now this is the one that I would like you to print out. Okay. Now this tutorial questions, let me show you. Let me open it up. You will be able to see this. Now over here, you will see a collection of past year exam questions, and they are arranged according to topics. For every topic, there are at least 3 questions. Say for example, topic 2, okay, which we are going to cover next lesson. There are 3 questions here. Question 2.1, 2.2, 2.3. Now what happened is this. After every topic, we will go through the past year exam questions. So you have an idea for every topic, what kind of questions you can expect. And given this question, how do we go about answering them? Okay. So I need you to either download this, or better still, if you can have a printer, print them out. Okay. We are going to go through these exercises in class. All right. So I need you to print this out. So far, so good. All right. Now, beside this, okay, remember I told you that there are 2 online tests. Okay. If you look at the content page, look at this. After topic 1 and topic 2, you can see there's this thing called in-semester formative assessment. This one, this folder. If you click in inside here, you will be able to see the quiz 1. Now, it's not available now because it's not due yet. Okay, it's not done yet. But once we have done topic 1 and 2 and we have done the tutorial, you'll be able to access this quiz. I will tell you when it's available and you can do your online quiz here. Alright? Okay, let me go back.
All right, this is what you will see when you log into your Blackboard. And all right, sorry guys, I was cut off for a while. Can you hear me now? Okay, good. Okay, sorry, just now I was cut off. Okay, now I'm back. Okay, but incidentally, did you all get the message I told you about the tutorial questions? Okay, let me show you again. Okay, this is the tutorial questions that I want you to print out. Okay, this is a collection of the past year exam questions according to topics. So after every topic, we'll go through questions like this. So you have an idea what kind of question you can expect and how to go about answering them. Okay, we'll practice this in class. So from this lesson onwards, I will need you to download this question, these tutorial questions. Okay, we'll practice them in class. Okay, yeah, it'll be good if you can print them out. All right. But if you don't want to print them, you want to save paper, it's okay. Okay, at least you download a soft copy onto your mobile device or your laptop. Okay. All right. Now let's continue from where we stopped. All right, now remember before the break, I was telling you about the accounting equation. Your assets A is equal to liability plus owner's equity. Now, I want to take you through examples of transactions. How different transactions will affect your accounting equation. But at the end of it, no matter what happened, your accounting equation must always remain equal, must always be balanced. All right. Now, these are examples of transactions. What are transactions? Transactions are any activities or anything, any events that happen in the business. For example, in PSB, when a student come and pay school fees, that is a transaction. When the school pays electricity bill, that is a transaction. When the school pays your lecturer salary, that is a transaction. Okay. Now, so I'm going to show you examples of different transactions and how different transactions will affect the accounting equation. But no matter what happened, the accounting equation must always remain equal. In other words, it must always be balanced. Now, over here, I want to highlight a very important point in accounting. Every transactions will affect two items. This is known as the double effect. Okay, this is known as a double effect. That means to say every transaction will have two effects. So these are example of transactions. I'm going to go through one by one. All right, the first transaction on December the 1st, Charles Taylor. Now Charles Taylor is the owner. He invests $30,000 cash to start a business. So this is the first transaction. The owner put in $30,000 cash to start a business. All right. Now, remember I told you in every transaction there will be two effects, the double effect. Okay. The first impact is, now you must understand when we first started, the company has got nothing, no assets, no liability, no owner's equity, zero, nothing. But now that the owner bring in $30,000 cash, the cash will go up. Do you agree? Cash is an asset. So the cash will go up. Now, on the other hand, because this $30,000 come from the owner, whatever comes from the owner, we have a name for it. What do we call it? We call it capital. So cash goes up, capital also goes up. Are you all following? Now, so in terms of the accounting equation, what is the effect? Well, cash is your asset, the cash plus 30,000. Can you all see that? Now, capital. Capital belongs to the owner. Capital is under equity, owner's equity. So capital goes up by 30,000. Now, can you see what happened now? Look at the accounting equation. Your left hand side and your right hand side. The left hand side plus 30,000. The right hand side plus 30,000. Is it equal? All right. So can you see the double effect here? And the accounting equation remains equal. Now, at this stage, I know some of you may be thinking, actually this $30,000, is it your cash or is it your capital? So this 30,000, is it your cash or is it your capital? Very good. It is actually both. Okay. It is both sides of the same coin. You know, if you look at a coin has got two sides. Okay, double sides. Okay, it has got two sides. So on the one hand, the cash will be able to provide benefits to the company. It is your asset. On the other hand, this $30,000 come from the owner. We call it capital. Do you see it? Huh? So this is the double effect, and at the end, the accounting equation remains equal. Now let's look at transaction number 2. Okay, the company now purchase supplies. So Charles Taylor Company, the name of this company is called Fast Forward. So now the company purchase supplies. Now I want to explain to you what are supplies. See, every time we come across a new term, a new word, I will explain to you. What are supplies? Supplies are anything that the company use in the course of running the business. Anything that the company need to run the business are known as supplies. For example, in the case of PSB, now PSB is a school. So the supplies that we need will be markers, pen, paper. Now all these are supplies. And of course, if you go to the toilet, okay, imagine when the school is open, when you go to the physical campus, you can see that in the toilet, there's a toilet paper, okay? And inside the toilet, you have the liquid detergent, the hand soap, and so on. All these are known as supplies. Are you following? And what are supplies? Supplies are actually your assets. Do you agree that all these items, all these supplies will be able to provide benefits to the company in the future? For example, what benefits does markers, pen, paper, what does this provide to the business, to the school? The lecturer can use the marker to write on the whiteboard, okay? So all this will provide benefits to the school. But what about toilet paper? Some of you may ask, is toilet paper an asset? Does it provide benefits? Well, if you don't understand what benefits toilet paper can provide, the next time you need it, you will know. All right? So all this will provide benefits to the business. These are known as the assets. Now, so what happened now is this. The company purchase supplies and they pay $2,500 in cash. So now what are the double effect? Number one, the cash will go down because when you pay, the cash will drop. The supply will go up. So in the accounting equation now, under assets, your cash drop by 2005 because you pay 2005. Now remember just now we had 30,000. Now we pay 2,500. We are left with 27,500. Under supplies, we have a new assets called supplies. Under supplies, we have $2,500. Okay, so total assets now 27,500 cash plus $2,500 supplies. Total assets 30,000. There's no impact on the right hand side. The capital is still 30,000. Does it equal? Can you see the accounting equation balances again? So far, so good. All right. Next. Transaction number 3. Okay. Now the company, fast forward, purchase new asset called equipment. Okay, equipment plus 26,000. If you add up the total assets, 1,500 plus 2,500 plus 26,000, total assets $30,000. Okay, right hand side capital still there, 30,000. All right, can you see the left hand side equals to the right hand side? Okay, any questions? Okay, I think apparently there was some lag earlier. Okay, okay, okay. Apparently we experienced some lag earlier. Okay, let me show you again. All right, first one is done, right? Okay, cash goes up, capital goes up. So this is equal 30,000 equals 30,000, right? Now, second transaction, the company purchased supplies, paying 2,500 in cash. So over here, when you pay, your cash goes down. So 30,000 minus 2,005, you're left with 27,500. Supply is an asset. Supply goes up 2,005. You add up the total is still 30,000. So left hand side 30,000. The capital right hand side is still 30,000. It's still balanced, right? All right. Transaction number 3. Okay. Now we purchase the equipment. Now equipment is also another form of assets because it will provide benefits in the future. Now, so when we buy the equipment for 26,000, okay. So when we buy the equipment for $26,000, now the cash goes down, but the equipment goes up. All right. So now under assets, we have 3 kinds of assets. Cash, 27,500 minus 26,000, I'm left with 1,500. Supply is still there, 2,500. Now we have a new asset called equipment. The equipment is worth $26,000. So what is our total assets now? You add up the 3, $1,500 cash plus $2,500 supplies plus $26,000 equipment. Total assets $30,000. All right, there's a question here. 2,500. Why do we add in the supplies? We add in the supplies because these are your assets. We add up because we want to find your total assets. Okay, so total we have $30,000 in assets. On the right hand side, owner's equity, your capital, we got 30,000. So this is equal. Okay, so far so good. Any questions? All right, good. Okay, let's move on. Now, transaction number 4. Now the company, fast forward, purchase supplies for $7,100 on account. Now we learn a new word. What is the meaning of purchase on account? Now, whenever you see this word purchase on account, or purchase on credit. Okay, what it simply means is you buy now, you pay later. Okay, so this is the meaning of buying on account or buying on credit. You buy now, you pay later. All right, what is double effect? Can you see we buy supplies again? Supplies is your assets. Supply goes up. But this time round, we purchase on account. That means to say we buy now, but we pay later. In other words, now there's no impact on your cash. There's no effect on your cash. Okay? But instead, because we buy now and we pay later, now we are owing. There is a liability. Okay? So the accounting equation now, if you look at your assets, under supplies, there's an increase in your supply by 7,100. We started with $2,500 supplies. We purchased another 7,100. Total supply now is 9,600. Got it? But there's no change in our cash because we did not pay. So the cash is still there. The equipment is still there. Our total assets now is 1,500 plus 9,600 plus 26,000. Total assets is 37,100 now. Now on the right hand side, we now have a new liability. We owe somebody money. Now, the name of this liability is called accounts payable. So now, what is accounts payable? Now, as the name suggests, accounts payable means it is an account that you are supposed to pay but have not paid yet. In other words, you are owing. Okay? So now they have a liability because you are owing somebody money. He has a liability called accounts payable plus 7,100. Okay, so you owe 7,100 here plus the capital 30,000. The total on the right hand side is 37,100. Can you see the left hand side is equal to the right hand side? Are you with me? Any questions? Okay, we have a question here. Okay, Li Xiang says, or rather Li Xiang asks, we record the supplies and equipment in terms of cash, right? Now, let me bring you back. Okay, now, when we record your assets, your supplies, and your equipment, it is not in terms of cash, it is in terms of value. How much is your supplies worth? Your supply is worth $2,500. How much is your equipment worth? Your equipment is worth $26,000. Now, meaning to say, it doesn't matter whether you pay in cash or is paid by credit, you pay later. The value of your supplies is still 2,500. The value of your equipment is still 26,000. But if you pay by cash, your cash will go down. Okay? Your cash will go down. So look at this transaction number 4. Can you see we purchase the supplies, but this time round is on account. That means we did not pay. So as long as we buy your supplies, the supply value will go up. So it'll go up by 7,100. So your supplies will go up. But because we did not pay, there's no change in your cash. The cash still remains. Okay? So you cannot say that the supplies and your assets are cash. No. Even if you don't pay, when you buy, the value will still go up plus 7,100 in this case. You got it? but there's no change in your cash. But what happened now is when you buy something on credit, on account, you haven't paid, and because you haven't paid, you are owing, there is a liability now. This liability is called accounts payable. And the accounts payable, now you owe 7,100. Can you see that? So it will always be equal like this. The left-hand side, your assets, must be equal to the right-hand side, your liability plus owner's equity. This is how it works. Okay. Now, it can never be one-sided. You can never buy supplies, asset goes up, and then you don't pay and nothing happen. It cannot work like this. Because when you buy and you don't pay, there must be a liability. You must have owed somebody money. Get the idea? Okay. So question, do equipment and supplies add value? Yes. Whenever you buy equipment, you buy your supplies, the value will go up. Okay. So this is how it works. Any questions? All right. Now look at transaction number 5. Okay, the company now provides service for cash. So the company start to provide consulting services and they receive $4,200 in cash. What do they receive? They receive cash. Still remember what is cash? Cash is your asset goes up. So under your assets, your cash plus 4,200. You got it? Now our total cash will be, just now we got 1,500 plus 4,200. Now our total cash goes up to 5,700. Supply no change. Equipment no change. Total assets now, if you add up, my total assets now is 41,300. Got it? But wait a minute. This $4,200 cash must come from somewhere. Where does it come from? It comes from the service that you provide. And in business, any service that you provide or anything that you sell is what you earn. And whatever you earn in accounting, we have a name for it. We call it revenue. Remember this? And revenue goes to who? Revenue will increase the owner's equity. So under owner's equity here, we have another new item here called revenue plus 4,200. Can you see the double effect? Cash plus 4,200, revenue plus 4,200. Now, let us see whether the equation balance or not. Total assets, 41,300. Total liability, we still owe 7,100. But your owner's equity now is a $30,000 capital plus the $4,200 revenue. The total now is 34,200 plus the 7,100 liability. Total on the right hand side 41,300. Is your left hand side equals to your right hand side? Alright, can you see how it works? So no matter what happened in the business, your accounting equation must always remain equal. This is the main point that we are stressing here. You get it? Any questions so far? Okay, very good. All right, next. Now the company pay $1,000 rent and $700 salary. Now, what are rent and salary? What is your rent? What is your salary? These are expenses. Okay? Anything that you incur in the running of a business are known as expenses. For example, when you start a business, you have to pay your rent, you have to pay salary to your workers. These are your expense. Now, when the company pay, can you tell me you use what to pay? You use cash, right? Okay. So when you pay, the cash will go down. So look at your cash. When you pay $1,000 rent, the cash goes down by 1,000. When you pay $700 salary, your cash goes down by 700. So just now we have $5,700 cash minus $1,000 rent minus $700 for salary. Our cash now dropped to $4,000. You got it? Supply no change, equipment no change. Total assets add up, drop to 39,600. You got it? But what is rent and what is salary? These are your expenses. So expenses will affect the owner's equity. Expenses here, rent, expenses for salary, total expenses 1,700. Okay. Now let's see whether it balance or not. Total liability 7,001. Capital 30,000. Revenue just now we got 4,002. Expenses 1,700. If you add up all, 39,600. Is your left hand side equals to the right hand side? Okay, can you see how it works? All right, now at this stage, I want to highlight something. Now, can you see your expenses, your rent minus 1,000, your salary minus 700. Now, why is there a minus sign? Now, the minus sign doesn't mean that your expenses goes down. Your expenses always increase, always goes up. But why the minus sign? The minus sign only shows you when there are expenses, your owner's equity, the value of the owner will drop. Okay, so this is how it works. When the company make money, revenue, the owner's equity will go up. When the owner have to spend money, they have to pay for expenses, the owner's equity will drop. Yeah, you're right. So you minus from total equity. That's why your owner's equity drop. That's why the minus sign. So when you see minus sign here, it doesn't mean that your expenses drop by 1,000 or drop by 700. No, it simply means when there's expenses, your owner's equity will drop. Get the idea? Huh? So this is what the negative sign there represent. So far, so good. All right. So I want you to notice something. Okay. So let's summarize what we have learned. Now, do you notice something? For every transaction, there's how many effects? Very good. There are two effects. Okay, double effect. Every transaction will affect two things, two items in your accounting equation. But whatever is the impact, whether it go up or go down or whatever is the impact, the accounting equation must always remain equal. Okay, this is the main thing that we are learning here. Any questions? Now, this is just an example, an illustration that I'm trying to show you. Okay, So I'm going to show you that your accounting equation, no matter what happens, it will always remain equal. Okay? It will always balance. This is what accounting is all about. So far, so good. All right, good. So now to summarize. Now, of course, this is from your textbook, okay? Oh, okay, we have a question. Can we open 2 pages, credit and debit? Okay, you're right. Now, over here, I just show you the effect on the accounting equation. But next lesson, lesson number 2, we will learn the actual recording process. How do we record all this down? And we will record using debits and credits. You will learn in lesson number 2. Okay, so don't worry. All right. So the actual way of recording this transaction is using the debits and credits, which we'll learn in topic 2. Okay, lesson number 2. All right. But here, just to show you the impact or the effect. Now, this is how we show the effect on the accounting equation, but this is not how we record. Okay, how we record, we will use the system of debits and credits. We'll learn it in lesson number 2. But here, let's look at the summary. It doesn't matter whether you have only 1 transactions or 10 transactions or 100 transactions. At the end of it, your total assets must always be equal to total liability plus total owner's equity. So if you add up the balance at the end, your total assets add up, it must always be equal to your total liability plus owner's equity. They must always remain equal. So far, so good. Any questions? All right. Okay, the last part. Okay, the last segment of today's lesson. Now, remember the process of accounting. Okay, if I can bring you back to the very beginning of today's lesson. Remember, I asked you what is accounting? Accounting is a process. 3 things. Number 1, you must identify the transactions. And one more time, every transaction will affect how many things? 2. There's a double effect. Okay? But whatever the impact, the accounting equation must always remain equal. Number 2, we must be able to record all this down. And how do we record? Okay, we'll record using the system of debits and credits. This one we'll learn in lesson number 2. All right, next lesson. And number 3, after you have recorded all the information, you must be able to communicate this information to the users. You must be able to prepare the report. Okay, now this report we will learn in topic 3 and 4. Okay, this recording we will learn in topic 2. So you will see that actually the first 4 topic 1, 2, 3, and 4, they are actually interrelated. Or it is a whole process of accounting. It's what accounting is all about. Okay, so today I'll just give you a brief overview, a brief run through. But over the next few lessons, we will go into details. Okay, how to record. Okay, in topic 2, how to report in topic 3 and 4. Get the idea? But now I just want to show you a sample of how your reports look like. Okay? Now these reports are known as your financial statements. The word statements means reports. Okay, your financial reports. So For today, I just want to show you how the reports look like. But in topic 3 and 4, we will learn how to prepare the actual accounting reports, the financial reports. Okay. Now, so the financial reports, there are 3 main reports, or rather 2 main reports. Okay. The first one is called the Statement of Comprehensive Income. Okay. Now, those of you who have done accounting before, you probably learned this using the old name, the old title. It is called Profit and Loss Account, or for short, we call it P&L, Profit and Loss. Okay, but the new name that we are learning now, this is called the Statement of Comprehensive Income, or the income statement for short. Okay, now number 2, I'm going to call this 2A, is a statement of changes in equity. Okay, this statement or this report will show you how your owner's equity changes over time. And 2B is a statement of financial position. It will show you the position of a company, what they have. It will show you all their assets that they have. It will show you all the liability that they owe. And it will show you what belongs to the owner. In other words, it will show you your accounting equation. This is a statement of financial position. So far, so good. Okay. Now let me show you how it looks. Like. Okay. First one is a statement of financial. Is a statement of comprehensive income. For short, we can just call it income statement. Now, so what is income statement? Income statement. What income actually means? Profit. And do you still remember how we calculate profit? Profit is revenue minus expenses, right? So your income statement actually shows you all the revenue that the company earn and all the expenses that they incur. Okay, so if you take all the revenue minus all the expenses, the balance is the profit. Are you with me? So let's look at this example. The income statement for this company, fast forward. So the revenue are consulting revenue, they earn 5,800. Rental revenue, they earn $300. Total revenue add up, they earn $6,100. Okay, this is the R, revenue. Got it? Now, expenses. Well, the company pay rent 1,000. They pay salary 700. Total expenses $1,700. How do we get the net income or the net profit? Well, the word income means profit. How do we get the net profit? Take the revenue 6,001 minus the expenses 1,700. Total profit 4,400. Got it? Any questions? Any question, guys? So far, so good. Okay. So this statement, this report, this is called the income statement. So how much did the company earn? $4,400. All right. The second statement, the statement of changes in equity. Okay, is the one below. Statement of changes in equity. The top one is the income statement. I showed you already. So now let's look at the one in green here. Statement of changes in equity. Now, can you remember in our example here, the company is a new company. we first started, nothing. Okay, started nothing. Then on the 1st of December, $3,000. Got it? Then company profit of 4,400. Now, can you tell me? Okay, can you hear me now? Okay, good. Yeah. For a moment, there was a lag again. Okay. Let me start from the statement of changes in equity again. Now, the statement of changes in equity, the one in green here. Now, this company is a new company. So when we first started, there's nothing, zero. Then on the 1st of December, remember the company put in $30,000. So the capital now is 30,000. But for the whole month of December, you take the revenue minus the expenses, there's a profit of $4,400. But tell me, this profit goes to who? So imagine you are the owner of this business. You started the company with 30,000, but the company earned $4,400. So this $4,400 goes to the owner. Can you see how it works? So you started with $30,000. The business earned $4,400. So now you got 34,400. Is that correct? Your value goes up. But in our example here, there's a withdrawal. Now, what is another name for withdrawal? Anybody knows? Capital is what the owner put in. Withdrawal, very good. Another word is called drawings. Drawing is what the owner took out. So total now you got 34,400, but the owner took away $200. So now the equity is 34,200. Yeah, whatever the owner withdraw. Okay, drawings. Okay. Can you see this 2A statement of changes in equity? It will show you how the equity changes over time. Okay, from nothing to 30,000 to 30,400 to 34,200. Got it? Any questions? All right, the last one. Now, the last report is called the statement of financial position. Now, your statement of financial position will show you what the company have, what the company owe, and how much of this belongs to the owner. In other words, it shows you the accounting equation. So, you have your assets on one side. The assets comprise of your cash, 4,800, your supplies, 9,600, and the equipment, $26,000. Total assets, if you add them all up, is 40,400. This is your assets A. Your liability, we still owe our accounts payable, 6,200. Owner's equity, we actually found out from here, 34,200. Now, over here, I show you in 2 steps, changes in equity. But in practice, these changes in owner's equity you don't have to show it separately. This whole thing, you can actually cut this out and paste in here. Okay. So in effect, we will only produce two statements: the income statement, okay, and the statement of financial position. And the statement of changes in equity, we do not have to show separately. This whole thing, we cut it out and we paste it inside here under equity. You got it? Okay. So since I've already showed you, the owner's equity now is 34,200. So this is your liability L. This is the owner's equity OE. Now, at the end of it, when you prepare your reports, your financial reports, financial statement, if you have done everything correctly, your financial statement must balance. Now, what do we mean to say that it must balance? Your total assets, 40,400, must be equal to your liability, 6,002, plus the owner's equity, 34,200. If you add these two up, can you see it's equal to 40,400? Can you see that your left hand side must be equal to your right hand side? In other words, it must balance. That's why this statement of financial position, okay, the old name, the previously, it is called the balance sheets. Okay? Why? Because it must balance. That is what it is all about. Any questions? Okay, very good. Now, at this stage, you don't worry about the format, how to record this and so on, because we're learning in topic 3 and 4. But now it's just to show you how it looks like. Okay? All right, let's recap. Okay, today we learn a few items. What are assets? Okay, assets must satisfy 3 conditions. There must be ownership, it must have a value, and it must be able to provide benefits to the company in the future. So example of assets, your cash, your accounts receivable, your prepaid expense, your fixed deposit, your inventory, your furniture, your motor vehicle, your equipment, your building, and so on. All these provide benefits to the company in the future. They are your assets. Now, the second category of items are called your liability. This is what you owe. Example of liability, your bank overdraft, accounts payable, accrual, short-term loan. Okay, you got your mortgage loan, debentures, long-term loan. Now, don't worry about all these names. Okay, these are all whatever you owe. These are all your liabilities. So far, so good. Then we have your revenue. Revenue is whatever you earn. Okay, whatever you earn from selling, we call your sales. Whatever you earn from providing a service, we call it service revenue. Okay, what you earn from renting out is called rental revenue. What you earn from commission income, and so on. Okay, all these are your revenue. This is what you earn. And the last category are your expenses. Expenses are whatever you spend. So they include your purchase, okay, your advertisement, your freight in. Now the word freight means transport costs. Okay, these are your expenses. Your interest, commission expense, your depreciation, and so on. All these are example of expenses. Are you with me? Any questions? Okay, very good. All right. And you know what? This is the end of topic number 1. Okay. All right, great. All right, guys. Uh, okay, so you can see yeah, it feels a little bit awkward because I don't get to see you, okay? But we have no choice. Now all our lessons are online, okay? Hopefully the situation will get better and I will get to see all of you very soon, okay? But in the meantime, lesson must still carry on. So even though it is online, we will still provide you all the support that you need. So if you have any questions, you can either ask me now, okay? Or you can always play back. Now, if for whatever reason you miss out certain part of the lesson, you're not sure, you can always play back. There's a recording of the lesson. Okay, you can play it back. Or if you still have any question, you can always email me. Okay? All right. So this is the end of today's lesson. Now, from next lesson onwards, okay, from lesson 2 onwards, I need you to print out or at least download the tutorial questions. Okay, because from next lesson onwards, after every topic, we will practice past year exam questions from the tutorial questions here. All right, so I need you to print this out, these questions out, okay, and we are going to go through them in class. Okay, and where can you find this? It's all available on Blackboard. Okay, if you log into your Blackboard, go all the way down, there's this folder called revision. So if you click inside this folder, there's a file called tutorial questions. I need you to print this out. All right. Any other questions? Okay, good. If there are no other questions, that's it for today. All right. I will see you next lesson. Okay. Thank you very much. Yeah, that's it. Okay.